Hello and welcome to the World Built Environment Forum webinar series. This webinar comes to you with the support of Colliers International, the forum's premier partner, and our executive partners, Glodon and Shanghai Oriental Investment Supervision Company. I'm Sean Ellison. I'm a senior economist with the RICS. I'm based out of Sydney, Australia, and I cover Asia Pacific as well as the Middle East and Africa. I'm delighted to be joined today by Dr. Henry Chen, who's head of research for APAC and MEA at CBRE, sitting right now in Taipei. And today, what I'm going to do is give an overview of the results of our most recent Global Commercial Property Monitor. Now, it's really no surprise that you know what we've seen from Q1 to Q2. There's been an elevated degree of uncertainty around the shape of the recovery. I'm not going to sit here and speculate on where, how this pandemic will evolve or what the recovery will look like. What I'd rather do is just sort of sit back, let the data do the talking, acknowledge that we don't know what we don't know, but also that a V-shaped recovery is sort of out of the picture from where we see it now. A few notes on the Global Commercial Property Monitor before we get into the results. This is a quarterly sentiment survey, and it's important to remember when you're looking at the data that it tracks changes in conditions in commercial property markets. So what that means is when we're saying something is negative or something is positive, that could be increasing or decreasing from a very high or very low level. So this is a measure of flows, not a measure of stocks. The data itself can be displayed at the regional, national, and subnational levels. So today we'll be primarily looking at the regional and national levels, focusing on the results for the Asia Pacific and the Middle East and Africa. But we do have the data available at the city level as well. And the global and regional data, we weight that using LaSalle Investment Management estimates of commercial property market size to give a bit more of an accurate description of shifts in sentiment regionally. So in the most recent quarter, we have data for 37 countries globally. We get responses from many more countries than that, but these are the countries where we see that we have substantial enough samples where we feel comfortable in actually publishing the data. Overall, we had more than 2,000 unique responses. What you'll see a lot of this data is displayed at is in something called a net balance format, and that's the preferred method for measuring sentiment. So all that does is it subtracts the percentage of contributors who respond negatively to a question from those who respond positively. There's an example on the screen, which is fairly self-explanatory. There's a few benefits to measuring data like this. One, it tends to be forward-looking. So it tends, because the data tends to move a lot quicker than hard data. And depending on the jurisdiction that you're looking at, you're looking at between a 6 and 12-month lead time over hard data for various soft data indicators that are included in this survey. It also is a more accurate measurement across borders because you don't have to deal with pesky measurement errors and other things that you have to deal with when you're measuring things like square footage and other aspects of commercial property data. And also what it also gives is a consensus look at where the market believes that commercial property indicators such as rents and capital values are going. And that's probably one of the more powerful measurements. And just because everything is quite fast moving these days, it's important to note that the responses to this survey were collected between the 10th of June and the 13th of July 2020. Of course, during that time, some economies were coming out of lockdown, some economies were going into lockdown, some economies were still in lockdown. So that obviously does flavor the nature of some of these responses. So just something to keep in mind. And a very last note, there is a small sample size adjustment that we do for some of the subnational markets when we display them, when we want to display estimates. The formula that we use there that's not really relevant for this webinar. And if there's any specific questions about this, feel free to reach out to me afterwards. Okay, so getting into the results. So we obviously saw a very sharp fall in sentiment during the first quarter of 2020. Oh, sorry, just there we are. And that's really been exacerbated in the second quarter. So the one key difference really between the first and the second quarter is that there's been a bit more of a lagged impact from the European countries, where the impact wasn't quite as severe when we were collecting the Q1 data. For the Middle East and Africa and Asia Pacific, however, both of these spots were hit quite hard during the first quarter, but sentiment seems to have deteriorated even further during the second quarter. And now if you look at sort of the past dozen years of this commercial property sentiment index, which is a combination of supply and demand metrics for the occupier and investment market, as well as an expectations component for each market. There was quite a bit of dispersion through much of the last decade. Even during the global financial crisis, there was obviously a fair degree of dispersion. There was a big kick up in things like commodity prices during that period. But right now we're seeing everything basically moving in the same direction, which really isn't that much of a surprise, I guess, given the nature of this specific shock. And as far as the depth of the pullback in sentiment, really the only thing that we have comparable to on record is the global financial crisis. So in places like Europe, this is obviously significantly worse than the Eurozone crisis of the early 2010s. Next slide, please. And what we're really picking up during the second quarter is that the pullback in demand that we saw during Q1 really deepened across each region. So whether you're looking at the Americas, Asia Pacific, Europe, or the Middle East and Africa, we saw a larger decline in demand for both occupier and investment markets during the second quarter, as we saw during the first quarter. And this is just sort of a breakdown of the components of global demand, so how things are weighted versus how they moved. And I think one of the things that really stands out from this specific chart is that a lot of the difference between the fall in global demand for commercial property markets from Q1 to Q2, that really took place in Europe. Now, there's one thing that's interesting that this chart doesn't really show. It's that if you separate out occupier and investment market sentiment on aggregate, investment market sentiment is actually performing substantially better than occupier market sentiment, and there's a reason for that, and that's because our indices have both a demand component and a supply component. So although demand's been the big mover, and that's really been the thing that's pulled back quite quickly during the first two quarters, the differentiating factor that we're picking up between occupier and investment markets is that in occupier markets, supply has also started to rise, and in Q2 we actually saw supply of occupiable space rise fairly rapidly. Now, obviously, there's some differences between the core asset types that we track. So, you know, we're seeing the availability of space to rent in retail and offices rise quicker than industrial. But nevertheless, the space to occupy, the supply of space to occupy is rising. For investment markets, it seems like the supply of properties has just been flat. So it looks like volumes have dried up, but perhaps thanks to some of the financial support provided by, say, central banks, liquidity support, you know, there's ample liquidity still sloshing around in markets. We're not seeing the same sort of spike in supply of properties for sale, and that's obviously putting very different pressures on something like capital values versus rents, right? Because you're not seeing the same amount of downside pressure on rents as you are currently on capital values. Now, how sustainable that is over the long term, that can be called into question. Obviously, you do at some point will need to generate income from these properties, but to this point, that's fairly limited, and that's something that we're picking up everywhere, not just in Asia Pacific, in the Middle East and Africa. It's also evident in the Americas and Asia Pacific. Next slide, please. So, and you know, sticking with that same theme, what we've really found is that from Q1, which is the inner circle, to Q2, which is the outer circle, more people are sort of acknowledging, more respondents to the survey are acknowledging that the current cycle is either is in some phase of a downturn, whether that's an early phase of a downturn or midway through a downturn. There's some discrepancy there, but you know, the share of respondents who said that the market's in a downturn did increase by a non-negligible amount from Q1 to Q2. Now, interestingly, and perhaps unsurprisingly, a lot of this increase seems to have come from respondents who formerly saw the market at their peak, right? And that's, I guess, not a huge surprise, given that the transition was really in Europe, where pre-COVID, a lot of people saw the market at its peak, and then now obviously see the market in a downturn. One of the more interesting things that we're picking up, though, from Q1 to Q2 was that the share of respondents who either see the market at the bottom of the cycle or in the early stages of an upturn has started to increase. And this specifically, a lot of this is happening in East Asia. So respondents in, say, China is probably the big one, where we're starting to see a larger share of respondents in China say that the market's in the early stages of an upturn. So it was about 1/5 of respondents from China believe that their market was actually starting to rebound, which is obviously a very good sign to see. But also some of the other East Asian places like Korea and Japan, and then excuse me. And then in some of the more emerging economies as well, there were some African economies, for example, where they actually saw their commercial market as being closer to the bottom rather than being in a downturn. So that was a fairly interesting result. Obviously, this ties into some of the Q2 GDP reads that we've had out recently. There was a read in China that came out substantially better than expected. So the economy grew 3.2% in Q2, which is obviously very different than what we're going to be seeing in other economies, both regionally and globally. There is a degree of caution around that result. Most of that growth was in fixed asset investment, so you know, government stimulus, things like infrastructure investment, whereas consumer demand remained negative. but it was still less negative than I think what was probably expected. So there was some sort of upside surprise that there may be a little bit of resilience left in the economy as we sort of move from a downturn into a recovery, whatever shape that recovery might take. Next slide, please. But even given that sort of backdrop, the expectations for rents and capital values remain fairly downbeat for the next 12 months. And this shows in net balance terms, so it gives sort of a relative comparison where you have a couple of outliers to the right, so your Sri Lankas and Nigerias, where rents and capital values are actually expected to increase. In part, that could just be because these countries tend to experience slightly higher inflation than some other countries included in the survey. Similarly, if you look at sort of the far left of the screen, you have, Oman and the UAE, which are likely to, potentially experience even deflation this year. So it's likely that they'll probably see a steeper drop in things like rents and capital values than would otherwise be expected if inflation levels were similar to other advanced economies. But what you can really pick up from this chart is that there is rents and capital value expectations have really converged around a fairly sort of negative reading over the next 12 months. And that potential optimism at the beginning of the year that this would be a very quick and very rapid V-shaped recovery seems to really have faded in many parts of the world. There is a slight distribution here where you see some European countries slightly more positive, and you have some negative outliers. Your countries like Hong Kong and the UAE, which obviously have multiple shocks that they're dealing with. But generally, everything is fairly subdued surrounding expectations for the next 12 months. Again, another sort of semi-positive note is that the outlook for Chinese commercial property is less negative than elsewhere. And this may also be a result of, we talked about the economy starting to return to growth. This may just be a result of China being really the first country hit by the pandemic, the first country to enter lockdown, but also the first country to leave lockdown. So the shape of the Chinese recovery could really inform the rest of the world as to how their recoveries will look. Next slide, please. Now, one of the things that we did that was interesting in this survey is, and as many of you who would have taken the survey would know, is we asked several additional questions this quarter about the risk to property markets and any sort of structural changes that you or survey respondents as valuation professionals and chartered surveyors would expect to see emerging as a result of the COVID-19 pandemic. So one of the questions we asked was around risk perception surrounding commercial real estate investment returns. And needless to say, there was a high degree of risk everywhere, right? So the results in and of themselves aren't really that informative because everyone, there's a period where we're looking at a global shock right now. Everything seems risky, so everyone has a high degree of perceived risk, right? So just displaying the results themselves probably wouldn't be that informative. So what I've done here is I've normalized the results and put them in terms of standard deviations. So on the left-hand scale is standard deviations. So every market here was perceived as risky, but the sort of the upward sloping nature of this chart shows you the sort of degree of relative increases in risk between markets. So the UAE was perceived as being more risky than, say, Switzerland. What I would say is that middle group of countries are all very, very close. So there's very little discernible difference between, say, Qatar, and even as far over as Poland. But then you really get the outliers on the right, where markets like the UAE, and especially South Africa, which was a couple standard deviations above where everyone else came in. These are markets that are perceived to be more risky than others. And it's fairly evident to see why. South Africa is one of the worst hit countries so far. And there's been questions around the policy response and the fragilities that the economy is currently going through with things like external debt. And the UAE is obviously a very large investable market that came into the COVID-19 pandemic on a weaker footing, and is obviously not only dealing with this sort of economic shock, but also a very steep decline in the price of oil, which is a very important commodity for the Middle East. Next slide. And the second question that we asked was whether there was a perception that businesses would scale back their office real estate footprint. So focusing on office space here over the next 2 years, because anecdotally, there's been a lot of discussions, one side of the coin as well. We've been working from home. We can see that it works at least part of the time. Businesses will realize that, this is something that they can incorporate more with cost savings in the works. So they'll be able to trim overheads, and they'll be less likely to continue occupying the same amount of space that they had previously occupied. And then obviously the other side of that argument is, well, no, there's a reason people locate in CBDs. These sort of agglomeration economies, these random chance encounters that we have at the coffee machine, where that might spark an idea that add to productivity. There's that's still very relevant. People still want to be located in the CBD. So what we were trying to do was to put some numbers around this, and what we saw was that there was a fair degree of consistency globally across the belief that there would be some expected reduction. So between sort of 7 and 9%. But as you can see, that's slightly lower. The belief is that that's going to be slightly lower in Asia Pacific, in the Middle East and Africa than it is in Americas and Europe. And that may be, it's tough to speculate exactly why that is. It could just be a structural issue. It could be a cultural issue. Perhaps working from home is already a little bit more embedded in the Americas and Europe, so companies will be a bit more open to it. It could be a financial issue that occupiers in the Americas or Europe have less wiggle room in their budget to dedicate to real estate. But on average, still we're looking at about a 7% reduction in both Asia Pacific and the Middle East and Africa is what is believed to happen. Next slide, please. And then in line with that as well, we asked whether there will be a rise in demand in suburban offices in place of urban locations over the next 2 years. Perhaps surprisingly, Europe was the most, I guess you could say, the most against this, whereas Asia Pacific and the Middle East and Africa were actually the most for this. There was a very strong belief that from between 10 and 20% of respondents in the Middle East and Africa and Asia Pacific, that there would be a reduction of office demand in the CBD in favor of larger suburban office places. I'm not as sold on this myself. I mean, from an RICS perspective, just anecdotally, we've been out of the office here since the second week of March. You know, and I happen to be in the office today. The only reason that is because there's construction going on in my apartment building. So had I done this there, all anyone on the call would have heard would have been a loud drill in the background. But even just walking through the CBD and coming back into the office, there's this different sort of feeling that you get when you come back into the office. And this could just be a personal thing from my perspective. But I do think there is something of value of being located in the central business district, whether it's from an amenities perspective or whether it's from an agglomeration economies perspective, where we actually gain productivity from where we're in fact located. Next slide, please. And then finally, what we asked was whether tenants were expected to demand more health and safety facilities, so health and well-being facilities in future rents. And if so, would they be willing to accept higher rents for them? So again, the response to the first part of the question was not really surprising. It was almost unanimously yes. In most cases, there was a 90% plus. Middle East and Africa was about 80% of respondents, where there's foreseen a higher demand from tenants for health and well-being facilities than there was in the past. And this might be one of the interesting conundrums that the industry faces over the next 2 years, is that tenants want these facilities but aren't so willing to pay for them, where especially in the Middle East and Africa, you only get about a third of respondents who think that rent increases will be justified on the basis of an increase in health and well-being facilities. So we'll have to see how that how the balance of that plays out over the next 2 years. So with that, that's a basic overview of the Q2 results. Those are available on rics.org/economics. Or if you have any specific questions, feel free to reach out to me directly. I'd now like to have a conversation with our panelist, Dr. Henry Chin, who's, as I mentioned, is the head of research for APAC and MEA for CBRE. And we're very lucky to have joining us today to share some of his insights and what he's picking up across these regions in the market. Henry, how are you?
Very good, Sean. How are you? Pretty well in Taipei.
Yeah, doing well in Sydney. Thanks again for joining us today. I guess if you wouldn't mind just beginning with a bit of a regional overview from both Asia Pacific and the Middle East and Africa over some of the broad trends that you're picking up, and really how the pandemic has impacted occupier and investment markets.
Thank you, Sean, and good afternoon, everyone. Good morning for those of you who are in the UK. Actually, we are definitely in an interesting era, and because initially our forecast, we do believe the COVID-19 will be under control probably toward the end of the second quarter of this year, but clearly the assumption was totally wrong. So you can see in the US, we've got a first wave has still lingering around. We do see some second wave in Australia, in Japan, in the Middle East, and even more interesting in Hong Kong, we do have experienced a third wave of COVID-19. So given on that situations, I think the economy recoveries probably is more likely to happen in the toward to Q4 of this year. I think in CBRE, our house view is more likely to see we continue to hold the V-shaped recoveries in the global economy, and then we are going to have a so-called Nike swoosh type of returns going back and moving to 2021. However, if you look at the real estate leasing and the investment activities throughout the second quarter, even now, we do see some the specific issues has been raised. It all depends on the COVID-19 and the duration of lockdown. I think particularly if you look at global scales, the slowness of the big cities, particularly in the US, to return to the normal working patterns, it's dragging the economy to slow down. And also because we won't be able to travel, and so corporate restrictions and general unwillingness to travel also weigh down the economy, leasing and investment activities. And then also people worry about, you touched upon that, whether people want to working from home or decentralized CBD offices. I think this is something is unknown, but people are very cautious on that part. So those are the concerns what we are facing. But nevertheless, we do feel like the lower interest rate and the extensive QE are really supporting the real estate value. But what I am seeing on the ground, we do think about the space market, the occupier point of view is facing a lot more challenges because occupiers want to cost savings, they want to make sure the operational resilience. As a result, all the expansionary plans are putting on hold. All the renewals, they prefer to delay or stay put for now. However, in the capital market, it's a different stories because I was talking to so many investors, whether they are institutional investors or private equity investors, they all had a significant amount of dry powders to deploy into the commercial real estate spaces. What stopped them not to deploy the capitals? Number one is about restrictions. We can't travel. Within Asia Pacific, Sean knows we have to quarantine for 14 days wherever we travel, or if you're not a citizen, you're not allowed to go to some certain countries. And number two, all the buyers, they want to have a huge discount. The discount range they're looking for is a 25% discount. But so far, as what we can see in the normal states, the discount normally around 5 to 10% maximum. We haven't seen much of a distress coming through the market, particularly for those core income producing assets. As a result, across Middle East, Africa, across Asia Pacific, pretty much globally, we are expecting to see the transaction volume is continue to be on the weaker side, and but we do expecting to see the recovery is coming throughout the first half of next year, because stronger liquidity, lower interest rate environment does help us to navigate through the downturn. Sean.
No, thank you very much, Henry. I want to touch on a couple things that you just brought up. And I guess I'll start from the most recent. One of the things that struck me was that when you were talking to investors, they have a lot of dry powder. There's a lot of cash out there that's waiting to be deployed. Do you believe then that once things start to turn around, will those expectations for a discount start to disappear, and that capital will start to be deployed a little bit more rapidly?
I think that's definitely the case. But to be frank, we are talking to so many buyers and sellers because our brokerages, our main business. But it's a great, I give you examples in the major gateway cities. It's grade A office buildings and blue chip tenant, and the people want to dispose. And the seller said, okay, I understand the current situations. I'm more willing to reduce the price by 5 to 10%. 5% maximum. However, we got a core investors who want to enter the spaces by the grade A office buildings. They are demanding for 15 to 20% of discount. Even the price they are entering now is cheaper than what you have experienced in 2019. But now the gap is still going to be quite wide. As a result, what we are seeing now is because a lot of fund managers, a lot of cross-border investments are pretty much putting on hold because people can't travel easily. So we see a lot of domestic investors, domestic insurance companies, domestic high net worth individuals that step in and to acquire those assets. And this is something we have seen quite a lot. And I think this is going to continue. I think the core managers, private equity funds, they probably realize the discount is not going to be the same as what they are expecting to. So I think even now, we see the deal flow is coming back. People are very eager to close the deal, even it's a lot smaller discount. I think people are willing to close the deal for now.
No, thank you very much, Henry. And I should add for all of the attendees that you do have the ability to ask questions as well in the question box, and I am monitoring those. So if you have anything for Henry or myself, please don't hesitate to ask. Henry, I guess I'm going to stick with the same theme right now, where you mentioned the shape of the recovery, that you still see that you see a Nike swoosh sort of recovery, where which might have been a little bit more slow than initially envisioned, but nevertheless is still a recovery.
Mm-hmm.
Do you see this differing at all between countries and regions? Is there the potential for perhaps some markets to recover a bit quicker than others, or are some markets at risk as of a slower recovery? I know you're not an epidemiologist, so I'm not going to ask your opinion on future outbreaks. But just structurally, do you see any sort of structural differences that might impede or speed up recoveries in different markets?
This is a brilliant question. Actually, we scratch our head to think about what sort of shape of recoveries, which region comes off first. So actually, we are doing a studies called CBRE Recovery Index. So we look at the major cities globally, and the paper will be out in the first week of August, next week, basically. So we look at the all the major cities, how they recover throughout the pandemic, what the current situation they are in. So we look at the economic activities, we look at the work patterns. Are you allowed to work from home? Are you free to travel? And what's the retail, entertainment, restaurant bookings on a weekly basis? And then this was the first time we are doing this. So a very interesting thing is, if you look at the red color, is most restrictive. The green color is more free, more open. I think Asia Pacific in general, we are sort of a greenish color, more green. And then if you look at the Middle East, and even for European markets, it's pretty much on the lighter-ish greens, right in between. And then you can see for the US, the color tends to be more pink and more reddish, because that's more restricted. The economy hasn't been recovered. You can see Americans, they even haven't been through the first wave. I think if we continue to monitor the spaces, I do feel a lot more comfortable. It's Asia economies is likely to come back first. And the reason is the government is reacting fast. And then Sean, correct me, I might be wrong. I might be very biased because I'm sitting here. And I think the Asian population, Asian culture seems to be more obedient. So therefore, we've been through the SARS 17 years ago. So we know how it takes to kill the virus, to control the pandemic. And so I think the obedient control, government fast reactions, I think it's going to help us recover the economy a lot more fast. Give you examples. If you look at what we have seen over the past few months, talk about the second wave in Beijing, even for the second wave in Melbourne, you can see the government has been reacting so fast to wider testing, lock down the cities, try to contain the spread of the virus. And then that's how fast the local government in each region react. The second part I want to highlight here is talking about fiscal monetary easing policies. I think compared to the US and European standards, probably Asian countries, economies tend to be a lot more controlled. They are more targeted to support the economies. For example, the more support, they won't throw the money to everyone. They are throwing the money to those impacted business, impacted individuals. And they also make sure they do have enough stimulus to do fixed investments, infrastructure, and to make sure we can create a job. As a result, I do feel like in the next year, this time, we are going to see a headline for the economy is the strongest GDP growth for decades in some part of the country, in this part of the world. And then based on our current forecast, surprise, surprise, we again upgrading the China's GDP. I think that China's GDP, if you ask me for last quarter, we're thinking about around 1% to 1.5%. And but you can see now we're upgrading our China's GDP to 2.3% for 2020 this year. And then you can see China probably is the only economies in the world which is going to register the positive GDP growth. I think China is going to leading the growth, showing the example for most of people to see there's a hope. So the V-shaped recovery is very prominent what we are seeing in Japan, in China. And we also see some recovery indicators also coming through Japan and Korea. So hopefully we will see more positive news throughout the second half of this year.
No, absolutely. It's certainly it was certainly welcome to see the Chinese growth outperform in the second quarter. And to your point on things like social capital, there does seem to be a high degree of variance in the relative amounts of social capital in different markets globally. And then lastly, on the targeted lending point that you brought up, it seems that almost the institutions, whether they're government or central banks, were just on a better footing heading into the shock. So they were able to act in maybe a more targeted manner than say their peers in other parts of the world. But that does seem to, as you've mentioned, stimulated more of a cyclical upswing in this part of the world than what we're seeing elsewhere, which is, I guess, positive news for us here. We do have a question from a Tin that's come in, and he's asked for any insights on the impact on rentals across Asia Pacific in Q3 and Q4 in 2020. So just what do you see rents doing? I'd add the Middle East and Africa on that, if you can comment on that, Henry. And perhaps if you can also maybe comment on sort of how rentals might differ between asset classes as well. That would probably be quite interesting to attendance.
Yeah, overall, it's a good question. Overall, across commercial real estate markets in Asia Pacific, we all revising down our rental forecast for 2020. I think some of them going to drag down to 2021, but up to 2021 is less likely to bring economic impact. It's more of an oversupply situations. But I can tell you that in terms of office market, the two markets that stand out, we revised down quite substantially is Hong Kong and Singapore. I think for Hong Kong and Singapore, Hong Kong is quite obvious reasons because of the weaker economy activities, as well as the social unrest, as well as the national security bill. There's a weight on the sentiment for the occupiers. As a result, the rental growth for Hong Kong is likely to decline by around 17 to 20% in 2020. So it's a very, very favorable to the tenant market. And for Singapore, it's very, very interesting. In the beginning of the year, we were very, very positive about Singapore's GDP rental growth for offices is a plus, higher single digit. But now we are revising down. I think that Singapore's rental growth is likely to be around 10 to 15% decline. That decline is pretty much coincide with lockdown, weaker occupier sentiment, everything what you can imagine. But that's pretty much the similar situation what we are seeing across the office sectors across Asia Pacific. The only two markets we are expecting to see so-called positive net effective rental growth is Taipei and Korea. I think in Taipei, it's pretty much on the lack of supply. It's heavily favored to landlord. They control the pandemic so well. Life is really back to normal here in Taiwan. And then no supply. As a result, we continue to see the historical higher rent, and the landlord is not willing to reduce, even doesn't provide a payment. For Korea, I think it's pretty much on the flight to quality, as well as the domestic demand has been really resilient. So as of now, we haven't seen any rental declines for the Korea Seoul office market. I think going forward, we think about the rental growth is going to be 0 to 3%. It's very flattish. But apart from those two markets, every single market, office sectors is going to register as a decline rental growth. For the retail market, as you can imagine, has been hit quite severely. It's all in the negative territories. I think the negative territory, of course, for Pacific, showing you in Sydney and Melbourne, you continue going to see the rental decline. For prime, regional, all the shopping centers rent decline. For Asia Pacific, very surprised. I think two markets is suffer quite substantially. Those two markets again is Hong Kong and Singapore. You can see the tourist arrival from Hong Kong to Singapore is pretty much non-existent for a quarter already. And for those retailers, they are fairly heavy rely on the tourist arrivals, tourist spendings. They are suffering a lot. So rental decline is going to be a double digit. And one thing we also noticed about Hong Kong is the rent. The last year we got a social unrest. The year before we got a trade conflict. The rent has been declined for 3 years in a row. But as of now, Hong Kong's entry rent is become very attractive. As a result, we got a lot of new interest inquiry for the spaces because the current entry point is back to 2003's level. So you can see the substantial decline also create the opportunity for lots of new retailers to thinking about where they want to enter it. And China as a prime locations, shopping centers rent is become very flat. We haven't seen any decline whatsoever. But of course, if you're thinking about a shopping center in a prime locations in the ground floor is very resilient, but upper floor, they do have some challenges to fill the store and also rental decline. For the logistic market, it's some part is we really everyone knows the logistics story is underpinned by strong e-commerce as well as the 3PLs. As a result, the second wave of structural changes is accelerating. So modern logistic facilities, when your tenant are focused on those two, it's going to continue to have a rental growth. I think every single market while we are recording, it's on a positive territories. Apart from Australia, I think Australia's the rental growth is a lot weaker. Even we see some rental decline because a lot of warehouse tenants, they are manufacturers, export oriented, and then has been hit quite severely. As a result, we don't see the rental increase in Australia. However, most of Asian economies, the logistic rent is in a positive territory. One market we have to notice again is Singapore. I think in Singapore, initially, logistic warehouse rent has been tightly controlled by the government. So it was cheap. It was quite a lot of vacancies. Because of COVID-19, the government is increasing the stock for medical supplies, for the food, for a lot of necessity-driven items. As a result, they take on a lot of seasonal demand for those logistic warehouses. As a result, Singapore's logistic rent has been revised upward, closer to 10% for 2020. And apart from Singapore, I think all the other markets is relatively resilient. The Hong Kong are more exposed, so but still doesn't see the strong rental decline. It's kind of flattish rent. But overall, we do revise down all the rent across the region and across all three sectors.
Oh, thank you, Henry. And I guess we have another very timely question coming in from Peng Chang, who asks, as a surveyor working in the retail industry, there is an increasing number of retail landlords facing demand sentiment issues due to various reasons like e-commerce. Is there an expectation for a wave of property transformation in the near future? So I guess this sort of steps into, I guess, a more medium to long-term outlook, where how do you see the sort of structural transformations that are being undertaken by the retail industry, but also, I mean, e-commerce is having many effects by like on the industrial and logistics sectors as well.
Yeah, I think if you guys go to CBRE, our website, you can see we did a retail flash survey, and last month, a retail flash survey, there's three things that we've been noticing that. Number one is to try to enhance the online offerings. I think we interviewed more than 200 retailers across Asia Pacific. I think around 78% of retailers are telling us they are going to improve their online offerings, particularly on the online delivering apps, and the variety of the products online. And you'll be even more interesting. Within those 78% of retailers, 80% of them coming from the luxuries. So all the luxury brands, they want to enhance their online offerings. So clearly, the omni-channel is going to be very, very important. They want to spend more money on the e-commerce sites. That's one key point. Second point, we also asked them, what are the major source of income for you in terms of retailers, your income, generate sales? Very interesting things. During the COVID-19, they say 30% of those retailers, they say the digital platform become their major source of income. 30%. Before COVID-19, it's only around 9%. So 30% of retailers, we look at a deeper dive, is coming largely from F&Bs, as well as coming from the sportswear. So you can see people don't buy the luxury brands, they do online, we search online, buy Nike, Adidas, or order the foods. So this is something quite significant changes. So you can see online platform is going to be increasingly important. That's why they want to invest in the apps, investment technologies. And the third one, talk about the physical stores. And still around 25%, if I remember correctly, around 25% of retailers, they are not sure how they're going to do the physical store. They haven't got any plans about closing down expansion. They still wait and see approach. However, we still got a 35% of the retailers, they are telling us they are going to consolidate their network. And so they are not going to expanding endlessly. They want to consolidate, to focus on the experiences, focus on the store, which is very, very close to the point of sales. And then that is translate into the need for future of retail. Because last year we already thinking about future of retail. Retail here to stay, but the format, the design of retail is going to be hugely different. Traditionally, we go to retail shopping malls. We circulate the shopping mall by our foot, by footfall. We walk around to experience the shop. Going forward, the design of a shopping mall should be very, very visual. Should be very, because we go to a shopping mall, we don't actually walk around. We look around to see which shop gave my attention. Therefore, I will be more of targeted shoppings. So for retailer, for the landlords, it's very important to create an indoor environment. It's a visual impact for the consumers. That's number one. Number two, people are talking about tenant mix. The tenant mix was so important, so increase a lot of F&Bs, but we do believe that this is outdated. For the shopping mall owners, they should think about what is a thematic mix. I think for Chinese, for Singaporean, for Hong Kong, they are very, very smart for that. So each month they create a new thing. Hello Kitty things, Doraemon things, or English Christmas things, they create a different thematic in order to attract the footfall. So no longer the tenant mix, but also the thematic mix. And the third one is people talking about the rent. Traditionally, you can see a lot of rent is coming from base rent plus turnover rent. But because on the rise of e-commerce, the shopping behavior is very, very different. You and I are going to go to the physical shop to try on the size. We order online. As a result, there's more and more landlords that are working with a retailer to talk about whether we become 100% turnover rent, or we call it social impression rent. So how we can capture your online sales translate into the future income for the landlord is a big, big question. We continue to work on the spaces with the developer to see what is the best formula for both sides. But we are going to see the structural changes in terms of rental lease agreements going forward. The fourth component, the last one, Sean, is talking about diversify your income stream. Get more income stream coming from the shopping malls. Traditional income is coming from the rent, but going forward, because we talk about thematic, we talk about your travel by visions, as a result, in-mall advertisement in-mall sponsorship is going to be very, very important. The classic example I can provide is you go to Singapore Changi Airport, and then the waterfall in the Changi Airport shopping mall. The waterfall is not owned by shopping mall, it's sponsored by HSBC. So HSBC actually paying for the shopping mall owners to gain the exposures. For shopping mall owners, you also get additional incomes from that part. So the future of retail is going to look very, very different. And the retail is definitely not to die, it's here to stay, but bad retail will disappearing, particularly in the West. But Asian, I deeply believe retail will be even more important. As a result, we also believe it's a good time. If you got the money, you got the management experiences, it's a good time to look into the retail. They do have a distress coming through.
Yeah, it seems like that might be one of the most interesting sectors to be involved with over the coming years, especially if you're able to keep up, I guess, with the pace of change. So thank you very much for that question, Peng Chang, and thank you, Henry, for the very informative answer. So I think with that, I'm cognizant of time, so I don't see any further questions from the audience. So I might take a moment to call the webinar here. Before we go, Henry, thank you very much for joining us. It was a fantastic discussion. I know I certainly feel a lot better informed after hearing from you, as I'm sure most of our attendees do as well. So thank you very much for joining us.
Thank you. Thank you for having me here, and stay safe.
And we'll certainly be looking forward to the paper that you guys are releasing next week. I'll definitely be giving that a read. Thank you to all of to everyone who've attended. We appreciate you joining us today. A reminder that we will publish a written summary of this webinar online, and please do feel free to share those with your professional networks. I'd ask you to take a few moments to let us know what you thought of today's session by completing an online poll, which will appear on your screens at the end of the webinar. Our thanks once again to Colliers International, the World Built Environment Forum Premier Partner, and to our executive partners, Golden and Shanghai Oriental Investment Supervision Company. You can follow us on Twitter, Instagram, and LinkedIn, where you can receive news of upcoming webinars and catch up on any that you may have missed. Please also take a look at our new podcast series, have a listen, and tell us what you think. And finally, you can download the WBEF app from the App Store or from Google Play. Thank you again for joining and for sharing your questions with us online. Until next time, goodbye.